we talked a lot about in prior episodes about the importance of having a team in place. You're going to have strategic buyers, you're going to have private equity firms, et cetera, looking at your company, and they come up with a valuation based on a multiple of profitability. But at the end of the day, they're investing in the team. Is this the team, right, that could take this, to the next level after I buy this company that's, has produced significant revenues and EBITDA profitability over the years. And so the team. So you're looking at the team, right? So you look at the team before they even get going. You look at the team when you're exiting your business. So when they come in to pitch, right, they're coming in or they're going to pitch you and say, hey, we want you to invest, whether it be $5 million, $10 million, $20 million in our business. What do you want to see in that team? Hi, everybody. Welcome back to our podcast, The Ins and Outs of Selling a Business. For those of you just joining us, my name is kdee. I'm president of Osage Advisors. Osage Advisors is a boutique merger and acquisition firm founded in 2001, working with business owners and their families looking to sell, typically with revenues of $5 million and up. So today I thought we would take a different spin towards the ins and outs of selling a company. We've talked a lot in the past about how you prepare, things to look out for in negotiations. But one of the things that I thought would be kind of fun to talk about is, how about when you start your company? I mean, we get the question all the time, when should I prepare to sell? And the pat answer is you should prepare to sell your company when you open the doors. So we're very fortunate today to have one of our own team members, Will Wilcoxson. Hi, Will. How are you?
Hello, Keith. I'm well. Thank you.
Great.
Thank you for having me on.
I'm glad you're with us today. And for our audience's benefit, Will comes from the venture world. He spent a great portion of his career working with venture capital firms, investing in early stage businesses, some startups, some pre-revenue, some already had a proven concept. But he has a distinct look at how he looks at the business itself from that perspective. Now, Will, I know you've looked at probably hundreds of deals in your life. And business owners, entrepreneurs we'll call them, because they look at a need in the marketplace. It could be a software, it could be IT, it could be a product, things that they have, they foresee as that could be very valuable to the customer long term. So whether that's a business customer, whether that's consumer. And I'd love to get your perspective as, what are some of the key traits that you and your team at your venture firms looked at when you were evaluating all these different deals?
Sure. So there were a lot of similarities along with differences. I think what we looked at first and foremost was the management team. The quality of the team that's really going to make the business work. And have they built in depth, and have they built in a recurring revenue model, for example? A solid value proposition. And generally, a solid value proposition is one in which you're providing a product or service that your clients see as beneficial, and they're willing to pay premium prices for that product or service. And in return, as a business, you have a long-term customer, hopefully with long-term and recurring revenues. So those are the similarities. And I think that when you get to meet a management team and understand what they're doing, what they would like to do, how they're doing it, how they treat the people, that's really the first and most important pass. Of course, the real due diligence happens after that, but those are the things that are similar both to early stage venture and to lower mid-market acquisitions or fundraising opportunities.
Yeah, it's interesting you say that, right? Because we talked a lot about in prior episodes about the importance of having a team in place. You're going to have strategic buyers, you're going to have private equity firms, et cetera, looking at your company, and they come up with a valuation based on a multiple of profitability. But at the end of the day, they're investing in the team. Is this the team, right, that could take this, to the next level after I buy this company that's, has produced significant revenues and EBITDA profitability over the years. And so the team. So you're looking at the team, right? So you look at the team before they even get going. You look at the team when you're exiting your business. So when they come in to pitch, right, they're coming in or they're going to pitch you and say, hey, we want you to invest, whether it be $5 million, $10 million, $20 million in our business. What do you want to see in that team?
I think the most important thing is that the team is really grounded in reality, and that comes from experience. And in the venture world, you'd meet a lot of CEO founders who are really excited, and they would talk about how big the market is and how hot this is, and how they talk about trends and stuff, and use some really flowery language to describe their venture and why it was foolproof. And that doesn't necessarily register, because you see that a lot, and you're able to turn off a lot of the noise, the superlatives and so forth. But when you meet a CEO, an owner, a manager, and they're showing you their metrics, and they can tell you, how many companies they have in their pipeline and what the dialogue is between them and where realistically they are in their process. Once you know that you have a team that's grounded in facts and has data on their side, and they're passionate about it, but realistic about it, that's probably the most important quality to see in a senior management team. They have to have the vision, they have to have the passion, but it's really got to be grounded in reality.
Yeah, we see that all the time. People, owners, entrepreneurs, they are passionate about, like you said, their product or service. It's the next greatest thing. It's going to have a long lifespan. It's going to capture a huge market share, all those kind of things. So you look at the management teams, that's kind of like your first pass, right? So now you're looking at, okay, what do they got, right? And you look at, and you've been successful. Your team, you've taken things that were, early stage through various, phases to a public offering. Right.
Uh-huh.
So, and, how do you evaluate the product, the market, et cetera, when you're looking at that? And again, you're venture capital is high risk. So you're kind of rolling the dice in some aspects, but you have bought into, the team, their prior successes, possibly, their vision, the market need, whether it's a service or product. How do you look at that? How do you feel about that to kind of say, okay, I'm willing to write that check right now?
Yes, so that actually is a great opening to some of the differences between like early stage technology investing and mid-market businesses. And that is that the technology companies from day one are built to be sold or built to be taken public. And they generally have a good deal of institutional capital behind them. So they will hire, say, a CFO, a good CFO, long before they need one full time, because that person will be in place and help them to grow more efficiently when they get to that point. Whereas, so they're built to be sold. They know that when their company is a success, they're going to sell and they're going to get a lot of money for their stock options or their stock. And that's how they make their money. With family businesses or lower mid-market businesses, many of which are family or closely held, those businesses were created initially to provide income for the owners. And they don't make the same investments up front, because every dollar that I spend on advertising is a dollar that I don't pay myself at the end of the month. And so they tend to back end load expenses as late as they can, because it's, the company was intended to provide an income for a family or families. And that's where you see a lot of the differences. And when you do the due diligence, Of course, maybe a family business hasn't grown that much in the past few years. Maybe it's, 10% a year. So it's growing nicely, but not a huge growth story.
Right.
And the CEO says, well, if I had invested more in sales, I could have gotten these projects or developed this product. And so therefore, some of the value that they're describing is going to be what's generated after the company is acquired or invested in. So I like to talk to existing clients and previous clients and prospective clients and get their take, because if they're well informed about a new product and perhaps they've had some involvement in how that product was described, they're probably going to be pretty objective. And that's what you're really looking for in all these opportunities are, what is the data that supports the fact that this is going to be the success? And sometimes it's anecdotal. Sometimes you have some pretty good analytics to show it, but you're really looking under the covers to say, does this make a lot of sense? And I think it's probably a little bit easier in the lower mid-market companies to see that potential than it is with some of the technology companies, because the technology companies are always building really quickly because things change very rapidly, and with the smaller, lower mid-market companies, there tends to be less or slower change.
You bring up a very interesting point because early stage investing, institutional capital is coming in at the onset of the business, right? The owner is willing to give up, our ownership group is willing to give up a significant amount of equity to bring in cash, but not just cash, also resources. Right. So
yes.
you look at one thing, but you have your own, everybody lives their own little island of how they run their companies, but they don't look at the broader perspective of the market and what other resources are out there. Not because, it could be just because they just don't know that these other resources are available. They give you a whole different perception or look, or the light bulb goes on that could help you build your business. Right. So when I look at it from early stage, like where you played a lot with some very successful businesses, maybe touch a little bit on that, because, money's one thing, but the human capital piece, the Rolodex, the relationships you bring into early stage, and again, you're spending money, right? You're investing in the growth, and you may not be profitable for 3 to 5 years. And there's a high burn rate, but you guys have a high success rate of prior deals. But maybe you could just touch about that piece of it, about how, other things that come to the table that open up the entrepreneur or business owner's eyes at the early stage, where you're going to say, hey, we're willing to spend this kind of money to bring in that seasoned CFO, for one, the sales and marketing group, SEO, consultants, web designers, marketing people, all this type of thing, branding the business. Maybe you can just touch about how you guys in the early stage really convince the ownership group that these are things that are really required to make you success, not just the product itself.
Yes, well, I was fortunate to back some very good entrepreneurs, founders, CEOs, and you really have to give the credit to them, because it's really, their vision, their baby, and they're the ones who really make it work. But on the margin, if you're, a venture investor and you're seeing maybe 300 business plans a year, and you're talking to maybe 100 of those owners, you get some perspective on, what is hot and what is not. Or you've, as a partner at a venture firm, helped to interview a couple hundred different candidates for a vice president of sales role. That, you might back a CEO who's really good at what they do, but they've never hired a vice president of sales, and they maybe don't know exactly, if it's a technological founder, they might not know all the questions to ask the salesperson, or they might not have the same network to be able to check out that salesperson or, vice president of sales. And so while the owner, operators, CEOs generally are very good at the day-to-day, strategy and execution of a plan, there's just so many of these one-off things that they haven't got the experience that you can help them with that really creates a lot of value. So, I can help to negotiate you a line of credit with this bank, or I've got a network of board members that could help to give you some advice in this industry. And that's where I think good investors really add the majority of the value. It's not in running the business, it's helping the CEO and the CEO's team to get access to the resources that they need, capital and, human and otherwise.
Yeah. So building a team is one thing, right? Building the right team is another. And so what I'm hearing from you is that, right, I need a head of sales, but who's the right person for that? Which is going to be one of the critical positions that when you're building a brand new business, is having that right person. So it sounds like to me, that, this is where early stage investors can really add a lot of value, because they know people that have been highly productive and successful in those roles working with early stage companies.
Yes, and that ability to work with the team, not micromanage, but offer up ideas of strategy or even execution. Because I might be looking at 5 new companies a week and going to board meetings to 5 companies a month. And so I'm meeting other board members, I'm meeting advisors, I'm meeting people that might be helping one company, this month, but then helping, one of my companies next month, and just building that network and understanding how to support without micromanaging is a task that or a skill that takes time to develop. And I was fortunate that I had some other partners. I was with Axiom Ventures in Hartford, and my partners Alan and Sam had a great deal of patience and insight, and they were good at picking companies to invest in and CEOs, but also very good at understanding how to work with those teams without, again, micromanaging or trying to do the work ourselves. It's really in support of the management teams.
Yeah, you just an interesting word you used in that less about your partners is patience, right? Mm-hmm. I mean, it takes time for a product or a service to gain traction, and and addition, when you're selling a company, it takes time to find the right partner or a company you're going to sell to that you feel good about, that's the right fit, that's going to continue on the business long term. So those are both two, right? Those are really important aspects of both sides when you're looking at early investors, and you're also looking at when you're exiting your business. And on that line, there's a certain time when patience runs out on the early stage, right? I mean, venture capital by its nature is risk capital, right? You may invest $100 million in 10 different deals, and one of them, that $100 million becomes $1 billion, but the other 9 just don't go anywhere. I mean, it could be 3 or 4 of them, or 5 or 6 of them just kind of plod along as small little companies and just never really gain hold, and a couple may fail. That's the nature of business. That's the nature of capitalism and entrepreneurship. Everybody stubs their toes, so to speak, and not everything works. So what would be a couple things that, on the things that didn't work out, things that, you did your diligence, you bought into the management team, you saw a perceived need for the product or service in the market, and then it just, flopped, so to speak.
Right. Yeah, I mean, things change and markets change and circumstances change. And, we have had some companies that didn't do well, and you need to know how and when to cut your losses. So maybe you have, a team that's, trying really hard. They're having some successes, but not enough. You don't want to put a ton of money in it, but also, the team is still, ready and willing to go. So maybe if you come up with a compromise where, we'll put in a smaller amount of money and prove it out over the course of the next 6 months. But at the end of the 6 months, if you don't really get there, you have to realize when it's time to cut your losses, and you don't want to throw good money after bad. And I've seen situations in which that has happened, and in which we said, hey, this is still a great management team. And even though maybe the company gets shut down, but we try our best to help put those people into other companies that we have. So, you're hopefully not disrupting, too much, but that's also the nature of early stage in technology. It's high risk, high reward. Right. And sometimes it doesn't work out. So you try to treat the people the best you can. And when it does, that sort of takes care of itself. But, again, it's being practical about where you are. One of the disciplines that a lot of companies don't do is they'll do projections, or they'll have projections when they invest in the company. But then do they go back a year later and say, how did we do versus the initial projections, and then 2 years later? Because even though there are good things happening at a company, sometimes maybe it isn't resulting in revenues or profits, whatever it is. So being objective can be difficult.
Yeah. So it sounds like that. It could be a timing thing, right? I mean, it could be that you have a great product, you invest in it, and all of a sudden 6 months later, Microsoft comes along or Apple comes along, and basically just captures the market. I mean, you can look back at remember the old days with Netscape and CompuServe. Those were the beginning of the internet, and then AOL kind of took those guys for a ride, and they were gone. And then all of a sudden, Google showed up. And then AOL became, and Yahoo and AOL became a second-line player because they just didn't keep up with the technology advances the other companies had. So, hitting the market at the right time is critical. Would you agree on that?
Oh, yeah. You can be too early. It's not always the first mover. You throw out a couple examples there. Betamax was better than VHS, which wasn't as good as compact discs. So, technology moves quickly, and it's not necessarily being the first mover. It's being the one that gets to the largest customer adoption within a short period of time. And that's why venture investors are willing to invest in losses, because if they can grow faster and be, the first provider in a new market, they're the de facto standard and they get a premium valuation. But, the number 2s and 3s usually fall to the wayside.
Well, I think that is a great way to to wrap up this segment, and love to have you back. I mean, you've been with Osage now for close to 3 years, and kind of pick your brain on experiences that you've had together with the rest of the Osage team on dealing with business owners who are looking to sell. So I hope you come back and we can pick this up on another episode.
I'd love to come back. And Keith, thank you for having me.
All right. Well, thank you, Will. Thank you, everybody, for joining us today. Again, my name is Keith D., President of Osage Advisors. To learn more about our firm, you can visit us on the web at osageadvisors.com. If you have any questions, please feel free to email me at kdee@osageadvisors.com or give us a call at 860-767-3273. Thanks again for your time and have a great day.